Welcome to Himalayan Stocks Gurukul, where we guide you towards long-term investment success with market stability.
Did the Nifty just rip the roof off the charts? Because while the rest of the world was sleeping, crude oil crashed nearly 6% to $79, handing India a multi-billion-dollar economic stimulus out of thin air. Watch this. The Nifty exploded 390 points. Banknifty added 980 points. And here is the kicker. FAIs had 89% of their positions short. This rally turned into a full-blown, panic-driven institutional short squeeze. The bears are getting slaughtered, and the bulls have officially taken over the 200-day moving average. To appreciate the velocity of this move, you have to look at where we started. Throughout July 2026, the Indian market was largely trapped in a sideways consolidation phase, a slow grind with no clear direction. Behind the scenes, foreign institutional investors, or FAIs, had built a historically massive wall of short bets against the index. Their long-short ratio had dipped to an extreme 11.12%. Essentially, nearly 90% of their index futures positions were betting that the market would fall. But that foreign bearishness hit a wall. Domestically, relentless and sticky retail SIP inflows through domestic institutional investors were acting as a constant buyer, creating a firm floor right under the market. The FIIs were positioned for a crash, but they were about to be caught entirely off guard by a global macroeconomic shift they didn't see coming. The trigger came from the global stage, specifically China. Deep-seated real estate issues and contracting industrial output created a sudden deflationary drag in the world's second-largest economy. When that Chinese demand collapse met an unexpected build in U.S. inventories, global energy markets liquidated. WTI crude oil prices dropped 5.83 because the country imports 80% of its oil. This price drop repairs the current account deficit and limits imported inflation. For the Reserve Bank of India, this drop provides sudden, massive breathing room for liquidity management without having to move the needle on interest rates. In a nation importing over $150 billion in energy annually, a 6% price drop acts as a massive fiscal stimulus. It immediately expands corporate operating margins and provides a significant buffer for the national deficit in the coming quarter. As the oil news hit, the FIIs who were short index futures were suddenly underwater. Their immediate reaction was a mechanical rush to buy back those positions at market prices just to stop the bleeding. This triggered a positive gamma loop. Rising spot prices breached key call option resistance, forcing a secondary wave of buying.
Options dealers had to buy underlying index futures to delta hedge, creating a self-sustaining cycle where every upside point forced more institutional buying. The data confirms this wasn't retail speculation. The Nifty saw a 401-point daily range on 411 million shares. That volume density is a signature of programmatic algorithmic accumulation. This vertical price action was driven by a forced liquidity shock. The massive short covering effectively broke the bearish momentum that had dominated late July. Skeptics argue that index rallies are just a few mega-cap stocks masking a broader market decline. But the market breadth today tells a different story. 2,174 stocks advanced on the National Stock Exchange, against only 857 declines. That's an advanced decline ratio of 2.53. The Nifty IT index was the standout, rocketing 3.28%. With the US dollar staying strong against the rupee, export revenues for tech firms are seeing a massive currency translation multiplier. Bank Nifty also settling at the absolute high of its intraday range shows that institutional buyers were unwilling to book profits before the close, anticipating more upside. With over 150 stocks hitting new 52-week highs, this move represents a clear transition from a period of distribution into a markup phase, backed by uniform participation across mid-cap and small-cap sectors. Technically, the Nifty has decisively breached its 200-day moving average and cleared its medium-term resistance zones. This puts us in a high-velocity environment where momentum is the primary driver. In this environment, mean reversion trading, trying to pick a top just because the price looks stretched, is a high-risk strategy that often leads to heavy losses during institutional short squeezes. The immediate mandate is to rotate capital into high-beta technology and private banking, while exiting low-conviction laggards like the media sector, which are failing to participate in the rally. The one remaining variable is the U.S. Federal Reserve. Their upcoming interest rate trajectory will determine if this global soft landing narrative can hold. As long as energy costs remain low and the Fed stays dovish, India's corporate earnings estimates are likely to see upward revisions. For investors, this creates a favorable risk-reward for deploying sidelined cash. The bottom line? Crude oil is down, and FAIs are actively hunting for cover. The Nifty has its sights set firmly on the 25,000 psychological barrier. Don't let the velocity scare you. This is a significant technical breakout. Use the dips to aggressively accumulate quality banking and IT stocks. If you want to ride this bull run with us, smash that like button, subscribe to Himalayan Stocks Guru Cool, and stay one step ahead of the smart money. Happy trading and stay bullish.